Welcome, listeners, to another deep dive into the intersections of global finance, technology, and policy. Today, we're unpacking a critical conversation from the Future Investment Initiative, FII conference, in Riyadh, Saudi Arabia, where some of the world's most influential financial minds are grappling with the pressing issues of our time. At the heart of this discussion is a sobering perspective on the U.S. fiscal deficit, economic inequality, and the transformative impact of technology, particularly AI, on markets and society. Let's break this down with historical context, global implications, and what it means for investors like you. The U.S. deficit, a ticking time bomb. The U.S. federal deficit has long been a point of concern, with spending currently at around $7 trillion annually against revenues of roughly $5 trillion. This $2 trillion gap is a structural problem that dates back decades, exacerbated by post-2008 stimulus measures and more recent pandemic-era spending. The idea of using tariff revenues, projected at $300 to $400 billion annually under current policies, to offset this deficit is a drop in the bucket. While tariffs might provide a short-term cash infusion, they're a gamble on sustained economic growth and lower interest rates, a bet described as a long shot by seasoned investors. Historically, reliance on growth to outpace debt has been a risky strategy. The 1980s saw Reaganomics push for tax cuts and deregulation to spur growth, but deficits ballooned. Today, the stakes are higher, with a national debt exceeding $35 trillion. Lower interest rates as a policy tool could reduce debt servicing costs, currently over $800 billion annually, but they also risk inflating asset bubbles, as seen in the dot-com era and pre-2008 housing boom. For investors, this uncertainty signals volatility in bond markets and potential pressure on the dollar if confidence in U.S. fiscal policy wanes. Economic inequality and the tech divide. Perhaps the most striking insight from this discussion is the growing chasm between the top 1 to 10% of society, those benefiting from tech and AI-driven innovation, and the bottom 60%, where educational and productivity gaps are widening. This isn't just a U.S. phenomenon, it's a global trend, visible in the UK, France, and beyond. The top tier, often tied to capital gains from tech unicorns rather than traditional income, drives stock market gains while evading conventional taxation through mobility and loopholes. Meanwhile, the lower tier struggles with basic literacy and employability, a dynamic reminiscent of the Gilded Age's stark wealth disparities. Technology, particularly AI, is a double-edged sword here. While it's fueling unprecedented productivity for a select few, think of the FANG stocks that have dominated S&P 500 returns for a decade, it's also displacing traditional jobs. The McKinsey Global Institute estimates that up to 30% of current jobs could be automated by 2030, disproportionately affecting lower-income workers. This polarization feeds into social unrest and political instability, as seen in recent populist movements across Europe and the U.S. Political dysfunction and global uncertainty. The conversation also touched on a breakdown in democratic compromise, with political polarization described as a win-at-all-costs war between left and right. This isn't just rhetoric, it's reflected in ongoing government shutdowns and policy gridlock. Historically, such internal conflict, seen during the 1970 stagflation crisis or the 2011 debt ceiling debacle, creates uncertainty that rattles markets. Globally, similar dynamics in Italy, France, and the UK amplify risks, driving capital flight to safe havens like gold, which has risen over 20% in the past year amidst geopolitical and fiscal fears. For investors, this political uncertainty translates to questions about tax policy, regulatory shifts, and even geographic diversification. The example of wealth taxes in New York City highlights a broader dilemma: raise taxes and risk capital exodus, or cut services and face social backlash. Either way, markets don't like unpredictability. Investment and policy implications. So what does this mean for your portfolio? First, the fiscal deficit and interest rate gamble suggest a cautious approach to U.S. treasuries. Yields may spike if growth falters, or if foreign holders of U.S. debt, think China or Japan, lose confidence in fiscal policy. Second, the tech divide underscores the importance of exposure to AI and innovation-driven sectors, but with diversification to hedge against overvaluation risks. Think of the 2000 tech bubble as a cautionary tale. Gold and other safe haven assets also merit consideration as geopolitical and fiscal risks mount. On the policy front, governments must address inequality through education and retraining programs to bridge the productivity gap. Otherwise, social tensions could derail economic stability. Tariffs, while a revenue tool, risk trade wars, as seen in 2018-19 with China, and should be balanced with broader fiscal reforms. Near-term catalysts to watch. Keep an eye on upcoming U.S. economic data, particularly GDP growth and inflation figures, to gauge whether the growth bet pays off. The Federal Reserve's next rate decision will also be critical. Any hint of sustained high rates could pressure equities.
Finally, monitor political developments, especially around budget negotiations and potential shutdown resolutions, as these will directly impact market sentiment. In conclusion, we're navigating a landscape of profound fiscal challenges, technological disruption, and political strife. The path forward demands vigilance, diversification, and a keen eye on global trends. Stay tuned as we continue to unpack these critical issues, helping you make informed decisions in uncertain times. Until next time, keep investing wisely.